Hey there and welcome. So, if you're a founder, you live and breathe your business model, right? You know every single part of it, your customers, your value proposition, how you're going to make money. But what if I told you that to really nail your fundraising, you've got to know your investor's business model just as well as your own?
Yeah, really think about that. A venture capital firm isn't just some big bank account. It's a real, high-stakes business. They've got their own customers, their own pressures, and a very specific way they define success. And cracking that code, well, that's the secret to getting their investment.
So today, we're going to pull back the curtain on how venture capital really works. We'll look at who a VC's real customers are, how their whole operation is structured, how they make money, and, most importantly, what all this means for you and your pitch.
Okay, first things first. We have to stop thinking of a VC firm as just a pot of money. It's a business, a very unique, incredibly demanding business. Let's start there.
So what exactly is a venture capital firm? Well, at its heart, it's a professional investment firm. They go out and raise a huge chunk of money, that's called a fund, from their investors, who we call limited partners or LPs. Then, their job is to invest that capital into a small portfolio of young, super high-risk startups in exchange for equity. You know, a piece of the company.
And here's the thing. Just like your startup, a VC's entire success hangs on its business model. This is their game plan. It's how they decide on strategy, how they're structured, and how they operate day to day. If we can understand this plan, we can figure out what really makes them tick.
All right. Every business has a customer. We know that. But here's what's so fascinating, and what a ton of founders miss. A VC firm is actually serving two masters at the same time. And this dual focus, it explains almost everything they do.
So, on one side, you've got the startups they invest in. That's you. They're portfolio companies. But on the other side, and this is just as important, you have the limited partners, the LPs. These are the big pension funds, university endowments, and wealthy people who actually gave the VC the money in the first place. So a VC has to create value for both sides of this coin.
For you, the startup, the value is pretty clear. First, there's the capital, which they give you in stages as you grow. But it's way more than just a check. You get their expertise. These are people who've seen the movie before. You get access to their incredible network for hiring or finding customers. And you get this powerful badge of credibility that makes everyone else take you more seriously.
But what about the LPs? What's in it for them? Well, for them, the VC firm is a gateway. It gives them access to an asset class, startups, that's super high risk but has crazy high return potential. They get a team of pros to find and vet the best deals, and, super important, they get diversification. The VC spreads their money across lots of startups, so one failure doesn't sink the ship.
Okay, so if you're serving two very different customers, you need a seriously well-oiled machine to pull it off. So let's look at the actual operations, the engine that makes the whole fund work.
It's a pretty disciplined cycle. First, they raise the money from LPs. Then the real grind begins, sourcing and vetting deals. And I mean, they might look at 1,000 companies to invest in, maybe 5. After they invest, they're not just passive. They're in there, advising and helping you. And finally, and you can't forget this, they're constantly working to guide you toward an exit, like an IPO or acquisition. That's how they harvest the investment and get a return for their LPs.
So what are their main resources? It's not physical stuff. A VC's most critical assets are all intangible. It's the partner's experience and who they know. It's the firm's brand and reputation. A strong brand attracts the best founders. It's their track record. Past home runs prove to LPs they can do it again. And it's their own secret sauce for finding and analyzing deals.
All right, now for the part that drives absolutely everything else, the money. If you really want to get why VCs do what they do, you just have to follow their financial model. This is where it all clicks.
VCs basically get paid in two ways. First, there's the management fee. They charge their LPs about 2% of the fund's size every year. That pays for salaries, rent, travel. It literally keeps the lights on. But that's not how they make the big bucks. The real money, the reason they're in this business, comes from investment returns. It's a share of the profits from successful exits, usually 20%, called carried interest. So their biggest payday is directly tied to your biggest payday.
But here is the absolute kicker. This number, this explains
everything. Venture capital isn't a game of averages, it's a game of home runs. In a typical VC fund, a tiny handful of investments, just 7%, are responsible for over 60% of the profits. Think about that. Most of their other bets will just break even or lose everything.
So what does that statistic really mean? It means they can't afford to invest in pretty good ideas. The math of their business just doesn't work that way. It means that, as Harvard Business Review puts it, every single investment they make has to have the potential to be a massive, fund-returning home run. No exceptions.
So we've taken apart the VC business model. We know their customers, their operations, their financial drivers. Now for the payoff. What does all of this mean for you and how you pitch your company?
Well, it means you have to look in the mirror and ask some tough questions. Knowing they need those home runs, is your business just a nice idea? Or does it have a realistic shot at being a billion-dollar, category-dominating, fund-returning monster? A solid business that makes a few $1,000,000 is fantastic, but it's just not a venture-scale opportunity.
Next question. Does your plan show a clear, believable path to an exit? Remember, for a VC, the game isn't over until they return capital to their LPs. They're not investing to sit on the board for 20 years and collect dividends. They are investing for a big liquidity event, an IPO or a huge acquisition, usually in a 5 to 10-year time frame. You have to paint that picture for them.
And finally, are you just asking for money or are you pitching them on a real partnership? You need to show that you get what they bring to the table beyond cash. Ask smart questions about their expertise, their network, how they'll help you grow. It shows you've done your homework and you see them as more than just a wall.
Ultimately, it all boils down to this classic quote from the legend Arthur Rock. I invest in people, not ideas. Because VCs know better than anyone that the initial idea will change, pivot, and evolve. The one thing they're really betting on is the team's ability to execute and find a way to win. They have to believe that you are the people who can build that home run.
So I'll leave you with this final thought. Stop thinking about your pitch as just selling your own company. It's a B2B sale. You are one business selling a partnership to another business. So now that you know how their world works, the only question that really matters is this one. How will you make your business absolutely indispensable to the success of theirs? You figure that out, and you're in the game.